What's up everyone, it's Scotty with Money Vesting. So welcome on board for another Market Open live stream here. So today we do have Jerome Powell giving a testimony in the Senate. So he is going to be live in about 25 minutes or so. And so is the market. So markets are going to open in about 25 minutes also. We have the poll going on, so make sure that you do vote. And the markets here right now, pre-market, we are down and giving up on some of the gains from yesterday. So the Dow Jones is down a little bit over 1.44%. We've got the Nasdaq ETF down over 1.5%, and of course the S&P 500 SPY ETF also selling off over 1.5% right now, with the 10-year yields dropping over 4%. So we are now coming down for the 10-year yields, trading as low as 3.15%. So certainly seeing a little bit of a pullback here, with energy also dropping. So we've got both crude and Brent dropping pretty aggressively here, down over 6% for both, coming down to low 100s per barrel. And as a result, all the energy stocks are also coming down pretty aggressively. We got Chevron down over 4%, Exxon Mobil once again giving up on most of the gains from yesterday, down close to 4% here. And BP is down over 3.64% pre-market, with XLE, that's the ETF for energy sector, down over 4.4% pre-market. Bitcoin here is just hovering at around $20,000, with Ethereum also hovering at around $1,000 right now. And we've got some of the other names like CleanSpark, Mara here pre-market slightly down about 2.7%. Coinbase is down, wow, almost 8%. Pre-market, so pretty much giving up on most of the gains from yesterday's rally as well. And then let's take a quick look on some of the updates here. So Dow futures declined more than 400 points as the market rebound fizzles. So last week, of course, the Federal Reserve hiked interest rates by 75 basis points. That was 0.75 of a percentage points, the largest increase in almost 26 years, so since 1994. And investors continue to deliberate whether the central bank can navigate a soft landing, with some Wall Street banks recently raising their odds of recession. So I did a video earlier, recession expectations from Citigroup have gone up to over 50% now. And they also pointed to 3 different scenarios. And the experience of history indicates that disinflation often carries meaningful cost for growth. And we see the aggregate probability of recession now approaching 50%. And Goldman Sachs believes recession is becoming increasingly likely for the U.S. economy, saying that risks of a recession are higher and more front-loaded right now. So Bitcoin could plunge even further to low of $13,000. One strategist warns. So Ian Hartnett, co-founder Absolute Strategy Research, says past crypto rallies show Bitcoin tends to fall roughly 80% from its all-time highs. And if you take a look at the overall Bitcoin's chart here from inception, it has had pretty dramatic drops here in the past, right? So this right here was back in 2011, from $33 all the way down to $1.86. That was a 94% decline. This right here was from $268 down to lows of about $65. That was a 75% drop. This right here from highs of $1,200 all the way down to $160. That was an 87% drop. And this right here, of course, was the most recent one, 2017, all the way down to $3,200. Down about 83%, and right now we are down a little bit over 70%. So 80% would put us down roughly at around 13,500, give or take, around those levels. So going over some upgrades and downgrades, Morgan Stanley resumes AMD as overweight. So Mornis Crespi Hardnet reiterates Amazon as a buy. We got Loop initiating Taiwan Semiconductor as a buy. Morgan Stanley reiterating Apple as overweight. We got Seaport downgrading Nike to neutral from a buy. Also, Bernstein downgrading Boston Beer to market perform from outperform. And JMP downgrades Airbnb to market perform from market outperform as well. So a little bit of a downgrade for Airbnb there. So Alex, Caddy, watch your Meta videos. So will you be buying more or selling Meta? You wrote time to bail as a title, but you did not make it clear about your own decision. So yes, I will be dollar cost averaging. I do think the fundamentals are still pretty intact. We went into over that spreadsheet that I showed you. Revenue, free cash flows, earnings, EBITDA. I mean, you name it. All those numbers are still pretty intact for the company. And based on those numbers, based on the valuation and where it's sitting at, based on the financials, the revenues, yes, growth concerns are there for pretty much a lot of companies right now, there's growth concerns. There's a lot of challenges with supply chain disruptions, higher interest rates, higher inflation, recession fears. There's a lot of growth concerns for a lot of companies. And Meta is no different. Advertising will slow down in 2022. That's a fact, right? People will spend less, and businesses will also spend less for advertising because there's fears around recession. But that doesn't take away from the fact that, starting 2023 or 2024 or over the course of the next 3 to 5 years, advertising, as it starts to rebound, as economy starts to rebound, as spending starts to rebound, then Meta will be in a much better position. Not just Meta, but the overall economy and the markets in general. So in my view, I think it is trading at an undervalued level, and numbers do make sense to me. They've got plenty of cash, so they can't go bankrupt. They've got little to no liabilities. So on paper, it's just, one of the most quality names out there that's trading at a very undervalued level. Similar to what Google, I think, is trading at an undervalued level. Similar to what I think AMD is trading at a very fair valuation right now, trading at about fair value. So you really have to pick and choose. I mean, there is opportunity in this market. There certainly is. There's a lot of stocks out there trading at about undervalued to fair value to very, very reasonable prices, discounted levels. And, their growth estimates may not be as strong in 2022 or maybe even the next couple of years. But if you do have a long-term vision, we're looking out 3 years, 5 years, 10 years out, then you can really find some really good deals in this market environment, given the low valuations, given the cheaper discounted prices. Now, that doesn't necessarily mean that we can't see lower lows. That doesn't mean that we can't go down even further. We certainly can. The S&P 500 trading at 16 times earnings on a nominal basis can certainly go down even further. On an inflation-adjusted basis, trading at about 28, certainly has more room to the downside, and that could, lead to more pain for the markets overall. But like I said, I'm not going to just sit on my hands waiting for the markets to drop another 20% for me to be a buyer. I'm still going to be dollar cost averaging, not as aggressively, still going to be doing that in smaller quantities, but nobody knows where the bottom really is. So that's, where I'm at with my expectations about the markets overall right now. So, okay. Meta trading at about 2017 levels looks like an awesome opportunity. Thoughts on bullish RSI divergence on the RSI. So with respect to what, Javier? SPY. Okay, so S&P 500. Let's take a quick look. So SPY here on the daily time frame. So we don't quite perfectly have a bullish divergence yet. So if you take a look at the price, obviously it's been making lower lows, right? So we have been selling off quite a bit. This is the overall lower lows for SPY. But we don't quite have a perfect higher low on the SPY. So there isn't really a very significant divergence playing out right now. If there is, we'll see it, we'll notice it. But right now, there's not any divergence on the relative strength index. I do want to mention, however, is that I was looking at this particular chart. And this is QQQ versus SPY. I don't know if Ranjit's here or not. He does some really good technical analysis, and he and I often talk about technicals on different indices, and this is a relative performance chart. This basically tracks the relative performance of one index versus another, and if QQQ is going higher, is going more than the SPY ETF, then this index goes up, and if this index is actually going down, and what it has been doing over this entire time, so since November of 21, we have been selling off. That means SPY has been outperforming the NASDAQ ETF QQQ. Now, one thing that I do want to point out is that if I bring up, let's see here, let me just do that. Okay, so if I bring up the S&P 500 ETF over here, so SPY, this actually I read that in stock charts, very, very good observation there. So if you bring out this chart with respect to where we are right now with this one, just want to make sure we're on the daily. There is some type of divergence playing in for growth versus some of the more diversified names, which is the S&P 500. And you'll notice that this one, as it was making lower highs, and this is back in November 30th till December 30th, you'll notice that we were actually making a higher high on this one. So this right here was actually pushing higher. So this is, a little bit of a divergence there where the SPY ETF was going higher, right? So it was making higher highs, and this one right here was actually making lower highs. And what we are witnessing now, again, just a small little divergence there, is that we are seeing this one particular index, this is again relative performance, start to make some higher lows, whereas over here, the SPY is making lower lows. So those are the two different inflection points, you can call it, that might suggest that there is some more upside for some of the more tech-related, NASDAQ-related names. we'll see if that actually plays out. Again, nobody really knows, but just a little observation there, that the SPY making higher highs and this index was making lower highs, so hence a divergence, and as a result the Nasdaq really got destroyed in that time period, down 30%, and now the SPY is making lower lows, whereas this one right here is starting to make some higher lows. Yet another divergence here once again. So could this be the bottom for the Nasdaq? Obviously nobody knows, but just a little bit of an observation that we can take a look into. But anyway, so we got 63% of people expecting the market to be red today, so down. Again, that makes sense because we are selling off here pre-market, although getting bought up intraday. So Nasdaq ETF only down 1.2%. We started the day down over 2%. So certainly getting a bit of a buying momentum here intraday, and the SPY here down over 1.5%, and the Dow Jones here only down about 1.4%. We've got Jerome Powell in about 14 minutes. So that should be really interesting, and we're gonna listen in on what type of questions the Senate asks, and they're obviously going to be grilling him because that's what they like to do, and hammer him on inflation, on interest rates, on monetary policy, and all the issues. So it should be an interesting time for Jay Powell. Volatility here, so VIX is up a little bit over 2.88%, so just a little bit over 31. They're gonna barbecue him. So VIX here up over 2.88%, so definitely pushing higher a little bit, back over 31. And taking a look at the spreads here, so 10 versus the 2 is down to about 7 basis points, down another 11% today, and the 10 and the 5 is still negative, up 11%, but still negative 7 basis points right now. And this right here is, of course, the chart on the year-to-date basis that we're looking at. Energy here. Energy really, starting to give up on some of the gains on a year-to-date basis. At one point, energy sector was up over 60+%. Now, XLE is only up 33%. So, be cautious with energy here. I know there was a lot of recency bias with energy, and that was one of the best sectors to own and the hottest sectors to be in. That's usually how, recency bias works, is that it kind of sucks you in, that this is the only sector that's working, and before you know it, Wall Street starts dumping because they've had their fun in this one particular sector. Not saying that it can't go any higher. I mean, oil prices, they can certainly go higher, as if this becomes a more persistent issue with the energy crisis, with supply chains and all that stuff. Oil prices could certainly get up to 147, 150 back from 07, 08. Those are the levels. But it's just not sustainable, right? It's not going to be something that goes on forever. So you just want to make sure that you are out before Wall Street gets out. Because if they start dumping pretty aggressively, then, obviously we can see some very aggressive moves to the downside. All right, let's take a look at Tesla here. Descending triangle breakout with volume 2 thoughts. Let's take a look. So Tesla here. So right now, I feel like it's mostly been consolidating sideways. With a support at roughly around 620s. If you're referring to kind of like this pattern as a descending triangle where, we're making some lower highs and we've got a support about 620. Usually, not always, but usually these descending triangles do resolve to the downside. I mean, they are bearish in nature because, the price itself is not able to make higher highs. It's not even able to get back to its previous highs. In fact, it's making lower highs, and we've got a support here. Not always, like I said, usually they do break to the downside, but right now I feel like there's more consolidation for Tesla with a resistance at 775, 778. So this right here is going to be the level to really be watching for Tesla right now. So, that's the level that we're watching. Pre-market, it's down about 1%. Yesterday, it was just an insane day, up over 9% for Tesla, $711.11. And yeah, very, very strong move for Tesla on the day. So this one actually pushed up 239%. So, back up to over 6%. So this is the S&P 500 stocks trading above their 20-day moving averages, now up to 6%. Earlier, it was less than 2%. So definitely pushing, some stocks pushing higher here from yesterday. And then this metric pushing higher as well. We got a lot of buyers stepping in. feel like a lot of polls need to change here from 62% people expecting red today. I don't know. We might have some intraday buyers for some stocks. So, because the last couple of weeks have been really brutal. Markets are down 10+% over the last couple of weeks. That's why for this particular week I was and still am a little bit more bullish than usual because of how oversold conditions were. We talked about the percentage of stocks trading below certain moving averages, a couple of weeks being really, really bearish for the markets. There's not any economic reports. Yes, Jerome Powell is talking today, so if there's no new news, if there's nothing new that he says, the market should be fine. But of course, if he says something that comes as a surprise to the markets, then we can obviously move on that on those comments. But Oscar says Fed talk equals red. Yeah, I mean you can definitely look at that, and we'll listen in about 9 minutes or so when that meeting starts. So. And how much time Powell speaks? He speaks at 9:30 a.m., so in about 9 minutes or something. So, yeah, when he's talking, we're probably gonna be. I'm probably gonna turn this mic off, and we'll just listen in on that. I'll bring up this screen, small screen at the top left, and then we'll listen in on that, and then. How much time? Well, he's gonna be speaking for at least a couple hours, I think. I don't think the live stream is gonna go on for that long. But we'll listen in at least for the first maybe 30 minutes or so, and see what he has to say. And definitely, the Senate is brutal. I mean, if you've heard any of the previous Senate testimonies and the people, to me and some of the other chairmen of the Senate, I mean, all these people just like absolutely grill him, asking him just insane questions, and obviously criticizing his policy and whatnot. So all right, so yeah, if you have any questions about any companies, any stocks, I'm happy to go over those as well. But yeah, year to date, the market's obviously still down. Stocks, equities, bonds, commodities, Bitcoin, pretty much all asset classes. I think every asset class is down except for real estate. Alex says, "Caddy, please make your live stream until Powell gets done today." Really? I mean, that's going to be a super, super long live stream. We'll see. We'll see how it's going, and then we'll take a look. Robinson says, "Poor Meta." Yeah, Meta's obviously been hurting quite a bit. So is PayPal. And there's been a lot of stocks, right? I mean, yes, Meta and PayPal obviously have been hurting quite a bit. But there's obviously been a lot of companies. I mean, Tesla's down about a third year to date. Apple, I think, is down over 20% something. So Apple is down a little bit over 23%. Amazon's down, I think, 40+% on a year-to-date basis. Amazon's down 35%, and then of course Meta. There's no comparison, down I think over 50%, 54% from its all-time highs. So 150 is really that next support that we're watching for Meta platforms. So that right there is going to be that level to watch for the company. Are we overdue for a bear market bounce? So Caddy, how is your Meta? Well, the position's down. Everybody knows that, obviously, because the stock's down 50% from year-to-date basis. So when the stock is down year-to-date 54%, obviously if you're invested year-to-date, you're also down. So that's not a surprise. But my plan is to, of course, buy at these prices. I mean, the price is really, really attractive at these levels. Still trades at an undervalued level, in my opinion, at least for the long term, if you're a long-term investor in this company. But anyway, so are we due for a bear market bounce? So we are, just from a technical standpoint, just given how many stocks are oversold, and the markets the last couple of weeks down 10%, 12% in the last couple of weeks alone. I mean, if you take a look at S&P 500 weekly chart, you can see how brutal the last couple of weeks have been. So this right here was a drop of 12.7%. So this week, that's why I'm a little bit more optimistic just for this week. Not saying this is going to lead to more of a sustained recovery, because we have to make that distinction. And we talked about it in our yesterday's market update and our Discord as well, because inflation is still elevated, Fed is still aggressive, recession fears are still growing, there's growth concerns, all those things are still there. So nothing really has changed on that front. It's just the technicals are oversold, and last couple of weeks do suggest that. So for those reasons, for this week, I'm a little bit more technically bullish, but that doesn't necessarily mean that we're going to lead to more of a sustained recovery, because the S&P 500 needs to go up over 28%, just to get back to where it was, to break even to all-time highs. And the NASDAQ, of course, needs to go up 40+% from these levels. Needs to go up 46% just to get back to where it was. All right, so still waiting. I've got the video here. Still waiting, but probably needs SPY will hit 500 today. Let's go. 500. Oscar, yes, thank you for reminding everybody. Come on, we've only got 61 likes. Come on, I deserve more than that. So I would really appreciate it if you guys drop a like. It'd only take a second. Thank you so much. Appreciate it. Uber, down over 2.3%. So this right here is going to be that support. Really to be watching for Uber right now, which is about $19 to $20 a share. So that's going to be the support. Of course, during the pandemic, we dropped all the way down to as low as $13, but that was, definitely got bought up very, very quickly. So support level is going to stay put at $19 to $20. And, resistance all the way up to $47, $48 per share. So certainly very, very oversold here. RSI, MACD's coming down, but I haven't really taken a look at the fundamentals all that much closely for me to have any opinions on the stock just yet. So, when they start to become profitable, when they actually start generating some positive cash flows, then I'll definitely take a hard look at this company. But for now, it's definitely on the watch list, but not really tracking it on a day-by-day basis or doing any fundamental analysis on the company just yet. But support level $19 to $20. Resistance is going to stay put at close to $47, $48. So NASDAQ here, it's now only down 90 basis points. Down less than 1%, but still red. We've got the SPY down 1.22%. And we've got the Dow Jones down over 1.28%. So most of that, buyers are stepping in for NASDAQ related names. Again, going back to this divergence that I showed you guys at the beginning of the live stream, definitely does hold some significance. As we're starting to see those higher lows come in for this relative chart, and the SPY continues to make these lower lows. So we'll see if you do see a little bit more of a sustained move to the upside. Austin says, when are you switching to a green mic? I'm switching to a green mic when inflation peaks. Once inflation peaks, well, obviously we don't know. We won't know when inflation peaks. We'll only know that in hindsight 2020. But once it starts showing signs of a nice consistent trend downwards, right? So if we get that the inflation numbers in July for the month of June, then we get those numbers in August for the month of July. If you see a consistent pattern, then you better believe it. The green mic's coming. The green mic is coming. So how about that? I'll let you guys pick the date. Okay. I'll do a poll. I'll run a poll on my Instagram. I'll let you guys decide the month and the week when the green mic should come. Okay. I'll let you guys decide. So I'll do a poll. And remember, this is all going to be because, so when the green mic comes on and the markets, if they still drop, that's not on me. That's on you. If you guys decide. Okay. So if you want to go that route, if you want to be a part of that poll, by the way, the markets are going to open in 10 seconds. So I just got to look at the markets here and we'll continue after. All right. So we got the NASDAQ here, S&P 500 top left, and the Dow Jones over here down about 1.1%. At least you drink from a green cup. Yes, I do, Mo. So this is the green cup that we're drinking out of. So All right, we are live for that 9:30 meeting. So they're just gonna open. They're just gonna start here in very, very soon. Just give it a minute or two, and they should start, I think. As soon as it starts, I'll just switch the screen and play that. Anyway, the NASDAQ here, where are we? The NASDAQ opening down 1%, so just a little bit over, just a little bit under 11,000 right now. We've got the S&P 500 down about 1.1%. The Dow Jones is down over 340 points, down about 1% right now. Let's take a look at some individual companies. We haven't opened that chart yet. Let's just do that right now. 4 split screens here. All right, so this is where we are. I'm gonna close Webull. I think it's gonna give me a lot of alerts like that. All right, so we've got NVIDIA. NVIDIA slightly down, close to 2%. 160s is where we are at right now. For AMD, we're pretty much flat on the day. PayPal is slightly down 80 basis points. Google is down 60 basis points. Tesla is pretty much break even right now. So we're almost turning positive. Amazon only down about 0.5%. And we got Meta Platforms is green right now on the day. I mean, it deserves at least some green, right? Yesterday was brutal for the stock selling off amidst every single stock was green, and Meta was the only one that was selling off. So, so far up over 1.3%, and Apple here just down about 70 basis points right now. So still waiting. Again, as soon as they go live, I will switch the screen and we'll listen in. It just says the semi-annual monetary policy report to Congress. Coverage begins momentarily. So we'll just wait. Hopefully we have no lags. Hopefully. It's not the Fed. Caddy's the one who wrecked the markets with the red mic. Oh, God. So make sure that don't change the mic as an option in the poll. Okay, so I'll do that. I'll definitely do that. So I'll do. All right, there we go.
Senate Banking, Housing and Urban Affairs Committee will come to order. Today's hearing is in the hybrid.
By the way, let me know if you guys can hear this. I'm going to turn the mic off. I'm going to turn on the MacBook audio. So make sure that you can hear that. Just give me a thumbs up in the live chat.
Been confirmed for a second term and has, this is his first hearing since then. We've seen the fastest growth in decades, faster even than China's, the lowest unemployment levels in 50 years. When Americans see the price of gas and groceries and rent going up week after week, available jobs and long-awaited wage gains don't mean as much and don't go as far. American families have been through enough the past 2 years, but for most people, it's not just the past 2 years that have been tough. Our economy hasn't worked for most Americans for far too long. Whether it's war or disease or financial crisis or sweeping over all of it, the march of globalization, workers and their families always bear the biggest burden, whether it's in the form of higher prices or lost jobs or low wages or devastation to their community or all of the above. It's not inevitable. The economy isn't physics. The ghost of Adam Smith would not recognize America today. There is no invisible hand of the market. When prices go up, it's because someone made a choice to raise them. In corporate boardrooms, when supply chains slow down or input costs go up or resources become scarce, executives make decisions. Do we cut back on bonuses? Do we rethink our stock buyback plan? Do we forego executive raises this year? Do we post quarterly profits that are still higher than last year, but maybe not quite as high as analysts thought they could be? Or do we raise prices and foist all the negative consequences of world events onto the people who can least afford them? We know what, in this country, most corporations do. They make the same choice they've always made, no matter the economic conditions of the moment. Most of these executives, they're not bad people, they're just doing their jobs, they tell us. It's the Wall Street system. These executives have to post profit increases for their shareholders quarter after quarter after quarter. The consequences for everything else be damned, and everyone else be damned. It's why for decades, Wall Street's rewarded the companies that squeeze their workers the hardest, companies that cut wages and retirement benefits, then cut corners on worker safety and on consumer protection just to make their stock prices go up. It's why too many companies fail to invest in their workers or their products. It's why companies moved manufacturing overseas and then neglected the supply chains that have been crippled during the pandemic, contributing mightily to inflation. It's why big corporations, Amazon, Starbucks, why they bust unions. It's why oil and gas companies would rather charge higher prices than increase supply to meet demand. We aren't witnessing traditional inflation. We're watching Russia and OPEC drive up prices and American energy companies engage in wartime profiteering. At the root of the higher prices and the empty shelves are the same problem that's been shipping jobs overseas and keeping wages low for decades, from Nevada to Massachusetts to Ohio. Corporate power, concentration reaching into every industry and market, into every corner of the economy. Our economy doesn't have to be a zero-sum game where Wall Street wins, everyone else loses. We can create an economy that reflects our values and works for everyone. We passed the American Rescue Plan, including the child tax credit, the biggest tax cut for working families ever. And despite what naysayers claim, of course it wasn't the cause for inflation. For the American families that I talked to, it empowered them to keep up with the cost of raising children. We passed the bipartisan infrastructure bill, a long-term investment in economic growth that creates more jobs, strengthens supply chains, improves our bridges and roads and public transit. Last week, President Biden signed the bipartisan Ocean Shipping Reform Act into law, bringing down ocean shipping supply chain costs. We need to build on these successes to build an economy that rewards work, making things in America. We should pass our Supply Chain Resiliency Act and begin to bring manufacturing back to our country. We should bring down the cost of prescription drugs and housing and childcare and elder care and other costs that have been rising for decades. We need to pass the Protecting the Right to Organize Act to empower workers in the workplace and our economy so they actually get their fair share. We need to crack down on corporate concentration and consolidation. Fair competition is good for workers and consumers and Main Street businesses. It's a core American value. It's how we bring costs down and ensure that workers don't always pay the price for powerful people's bad decisions, whether it's a dictator in Eastern Europe or a Wall Street executive. In a truly fair economy, people don't have to choose between two bad options, low wages or high prices. No one likes inflation. People want good jobs that pay a living wage. Americans want to work. They want to work with dignity. That's central to the functioning of our economy. And as Chair Powell knows, it's part of the Fed's mandate. We must continue to power workers and strengthen the labor market. Wages are clearly not responsible for inflation now. We can't forget that almost 6 million people are still looking for work, actual workers behind the numbers whose livelihoods are directly affected by the decisions the Fed makes. And as interest rates rise and financial stability risks increase, it's even more important to keep a close watch on the biggest banks so that excessive risk-taking doesn't create even more problems. Banks must have enough capital to withstand a crisis. They must serve their communities, not just enrich themselves with stock buybacks and exorbitant executive pay. And mergers must benefit the local community, not just shareholders. We've seen too much evidence of big Wall Street banks behaving badly, shunning small businesses, still raking in billions in overdraft fees, discriminating all too often against black and brown borrowers. Chair Powell, you must also ensure we have a strong payment system that works for Main Street Bank.
I'm sorry, there was just one comment in the live chat that was just like really, really funny. YouTube hides that because it's got like some words that I think YouTube kind of like censors it already. But it was just like really funny. That's why I was laughing. But anyway, let's just go back.
And democracy are missing one thing. They aren't backed by the full faith and credit of the United States of America. The Federal Reserve, our nation's central bank, must use its authority to protect consumers and the financial system from these risks. And you, Mr. Chair, must ensure that the Fed has the highest ethical standards. After former Fed officials profited off their positions in last year's stock trading scandal, It's up to you to restore the American people's and us to restore the American people's trust in this institution that's critical for a healthy economy. I was encouraged when you updated the Fed's policies, but we need rules that have the force of law. That's why we need to pass my ban conflicted trading at the Fed Act. As chair of the Federal Reserve, you have an important role to play to make sure our economy works for everyone, not just those at the top. I urge you to remember the millions of working Americans who are counting on you. I will turn to today's ranking member, Mr. Tillis from North Carolina, and then Chair Powell. And the first questioner will be Senator Warren, who has another engagement. Plus, it's her birthday, so every time birthday she gets to go first if she has. And I have to introduce a judicial candidate in judiciary, so I may have to step up. Your 80th birthday today, Senator Kennedy? Senator Tillis.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Congratulations on your confirmation. I was proud to support it. When you testified before this committee in March, inflation was at a 40-year high, and the Federal Reserve regional banks were stonewalling reasonable requests for information about their activities from banking Republicans. Unfortunately, neither situation has improved. Let's begin with inflation. Inflation is even higher now than we saw you in March. CPI is up 8.6 per year, a new 40-year high. Getting inflation under control is critical because American families are being squeezed every day by rising prices and mounting costs. Also critical to any discussion we have on inflation is an understanding of what served to turbocharge it. In March of 2021, the U.S. economy, as measured by the range of economic factors, was well on its way to recovery. Unemployment was at 6%. Down from its pandemic worst of nearly 15%, and continuing to make steady monthly improvements towards a tighter labor market. In fact, 18 states already had unemployment rates below 5%. They often cite a threshold to identify a labor market that's almost at full capacity. Likewise, consumer spending had recovered, and it was actually above pre-pandemic levels at 4.5%. And the personal savings rate had returned by 80% to its pre-pandemic state, indicating Americans were capable and willing to spend. Considering these factors and many others, CBO projected that the United States would return to pre-COVID economic levels in GDP output by mid-2021, just a couple of months away. At the same time, the Biden administration was aware of one major area of concern, the disruption of supply chains. In fact, President Biden issued a February 2021 executive order to review U.S. supply chains, in part acknowledging they were already straining to meet rising consumer demand. Yet despite these facts, a soon-to-be recovered economy, stronger consumer spending, and known limitations on supply side due to the documented supply chain issues, the Biden administration and congressional Democrats still somehow considered it responsible to ram through a partisan $1.9 trillion spending spree. It is little wonder how this catalyzed inflation we see today. And don't just take my word for it. Just last week, economists at Morgan Stanley blamed the 40-year high inflation on, this is a quote from their report, excess fiscal stimulus, particularly the last $1.9 trillion package at the end of March 2021. Adding, this is what turbocharged consumption and drove inflation to 40-year highs. Considering this damning assessment of the last reconciliation package, I can only add that any efforts to revive Democrats' currently stalled tax and spending legislation would no doubt worsen our economic condition. Regarding the Fed specifically, though I'm pleased you have begun taking drastic action necessary to right the U.S. economy, these actions are long overdue, and monetary policy remains too loose. CPI inflation now stands at 8.6% per year, a new 40-year high. But the Fed fund rate sits at 1.6%. According to the Fed's semi-annual report, the rate should be over 6% under the Taylor rule. This disparity indicates not only the lengths the Fed has yet to go to normalize monetary policy, but also the fact that the Fed has largely boxed itself in to a menu of purely reactive policy measures. Unless the Fed works quickly to move away from their discretion-based monetary policy approach that has remained consistently well behind the curve, I'm concerned the Fed will lose its credibility to effectively manage the national economic situation. Regarding congressional oversight of the Fed, I remain concerned that the Fed and its regional banks continue a pattern of stonewalling reasonable requests for information. The latest example concerns the fairness, transparency, and consistency of Fed decisions to granting highly valuable Fed master accounts. This is a significant public policy issue. Ranking Member Toomey, myself, Senator Lummis, and others have repeatedly requested information about this from the Fed and the Kansas City Fed, yet we still have few, if any, answers. Just this month, the Kansas City Fed refused to provide any information about its recent decision to revoke the master account for Reserve Trust, a non-bank fintech. This is significant given the controversy that arose in former Governor Raskin's nomination process when it was revealed that the Kansas City Fed reversed its denial of Reserve Trust application for a Fed master account following a call from Ms. Raskin. Now, months after defending the decision to grant Reserve Trust a master account, the Kansas City Fed abruptly revoked the account without explanation. The Kansas City Fed won't give banking Republicans information or even a briefing about this curious reversal. And it's important to point out that Republicans aren't the only ones who have found it difficult to conduct Fed oversight. Several of my Democratic colleagues, including Senators Warren and Menendez, have been vocal when they also found their oversight efforts met with resistance. To address this unacceptable state of affairs, Congress should increase transparency at the Fed. Two simple steps that Republicans and Democrats can take together are subject the Fed banks to FOIA, which they currently are not, and forbid the Fed from using FOIA exemptions to withhold information from any member of Congress, not just committee chairmen. The second idea is a bipartisan proposal that's already passed the House and something Senator Ossoff has mentioned with regard to various federal agencies in the past. Likewise, Congress should also explore making the presidents of the regional Fed banks presidentially appointed and Senate-confirmed positions. This is another bipartisan idea, as Senator Reid previously proposed this requirement for the New York Fed bank president position. And in 2015, Chairman Brown himself raised the idea during a banking committee hearing on reforms to the Fed. The time has come to revisit these sensible ideas and others in order to make the Fed more transparent and more accountable. Thank you, Mr. Chairman, and I look forward to Chairman Powell's testimony.
Thank you, Senator Tillis. We'll hear from the Chair of the Federal Reserve on monetary policy, the state of our economy. Congratulations again on your second term, second confirmation to your second term. Thanks for your service and your testimony. Please proceed.
Thank you, Chairman Brown, Senator Tillis, and other members of the committee. I appreciate the opportunity to present the Fed's semi-annual monetary policy report. I'll begin with one overarching message. At the Fed, we understand the hardship that high inflation is causing. We are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Inflation remains well above our longer run goal of 2%. Over the 12 months ended in April, total PCE prices, that's personal consumption expenditures prices, rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.9%. The available data for May suggests that the core measure likely held at that pace or eased slightly last month. Aggregate demand is strong, supply constraints have been larger and longer lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and fuel and is creating additional upward pressure on inflation. And COVID-19 related lockdowns in China are likely to exacerbate ongoing supply chain disruptions. Over the past year, inflation also increased rapidly in many foreign economies, as discussed in a box in the June monetary policy report. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. A box in the June Monetary Policy Report discusses developments in employment and earnings across all major demographic groups. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation poses significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. With inflation well above our longer run goal of 2% and an extremely tight labor market, we raised the target range for the federal funds rate at each of our past 3 meetings, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. In May, we announced plans for reducing the size of our balance sheet, and shortly thereafter began the process of significantly reducing our securities holdings. Financial conditions have been tightening since last fall and have now tightened significantly, reflecting both policy actions that we have already taken, as well as anticipated actions. Over coming months, we'll be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. We will make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you very much, Mr. Chairman. Let me, on behalf of Chairman Brown, recognize Senator Warren.
Thank you, Acting Chairman. I appreciate the help of the Chairman this morning, and thank you for being with us, Chair Powell. So Americans are struggling with rising costs, and all eyes turn to the Fed. Last week, you announced that the Fed would raise rates by 0.75 percentage point, the biggest increase in nearly 30 years. So let's talk about what the Fed is and isn't doing when it raises interest rates to try to bring down inflation. Let's start with gas prices. The price of gas is up 40% since Russia invaded Ukraine in February. Chair Powell, will gas prices go down as a result of your interest rate increase?
I would not think so, no.
Okay. That matters because gas prices are one of the single biggest drivers of inflation. Energy prices overall drove a third of the inflation last month, but the Fed's tools, as you say, have no impact here. So let's look at another necessity, food. Price of groceries is up nearly 12% this year. Americans feel the pinch. No matter how much groceries cost, people still got to eat. Chair Powell, will the Fed's interest rate increases bring food prices down for families?
I wouldn't say so, no.
Okay. So a Fed increase won't bring down these prices. And why? Because rate hikes won't make Vladimir Putin turn his tanks around and leave Ukraine. Rate hikes won't break up monopolies. Rate hikes won't straighten out the supply chain or speed up ships or stop a virus that is still causing lockdowns in some parts of the world. So let's talk about what interest rate increases can do. Chair Powell, you said last week that interest rate increases, quote, moderate demand. Can you just explain a little more about what that means?
Sure. So we think about interest rate increases as affecting financial conditions and then the economy through three broad channels. The first of which is interest-sensitive spending. So that's durable goods and automobiles and things like that. So interest rates go up, people's demand for as a result of higher interest rates will moderate or decline so that supply and demand can get into better balance. The second channel is just asset prices generally. Interest rates, as they go up, will cause asset prices to moderate across the economy, and people spend a little bit less out of their lower level of wealth. The third channel is the exchange rate, which is really just another asset price, and that just basically as the dollar strengthens. As rates go up, the dollar would strengthen, which would tend to drive.
So I appreciate this, and I do appreciate the explanation, but let me just see if I can just put a little more plain vanilla explanation of what's going on here. If I understand what you've said and what economists are saying across the board is that when you raise interest rate, there's going to be less money to invest, and that is, it's going to dampen business investment. Is that a fair statement?
I think the idea is to
Makes it more
moderate
expensive
demand
to invest.
so that it can be in better balance with supply.
Okay.
And
So
the current
it's gonna make it
situation,
more-
demand is well in excess of supply in some areas of our economy.
More expensive to invest, which in turn is going to throw workers out of work. And when they're out of work, they have less money to spend. So I get that rate increases stop companies from spending money to build new plants or to buy new trucks or to hire new people, right, Chair Powell? When money's more expensive, they're less inclined to do that. I think that's what you just said on asset pricing, right?
Well, in the labor market, you have, as you know, a situation where there's a shortage of workers, and there are two job vacancies for every person who's actively looking for work. So part of this is to get the labor market back into balance.
Well, I appreciate you call it back into balance. What I'm trying to get at, though, is what does the tool of raising rates do? And part of what you just said is that it increases, in effect, the cost to invest, to buy those trucks or new plants or to hire new people. The reason I raise this and the reason I'm so concerned about this is rate increases make it more likely that companies will fire people and slash hours to shrink wage costs. Rate increases also make it more expensive for families to do things like borrow money for a house. And so far, the cost this year of a mortgage has already doubled. Inflation is like an illness, and the medicine needs to be tailored to the specific problem. Otherwise, you could make things a lot worse. And right now, the Fed has no control over the main drivers of rising prices, but the Fed can slow demand by getting a lot of people fired and making families poorer. And while President Biden is working to increase energy supplies and straighten out supply chain kinks and break up monopolies and bring down prices, you could actually tip this economy into recession. So I just want to say, you know what's worse than high inflation and low unemployment? It's high inflation and a recession with millions of people out of work. And I hope you'll reconsider that as you before you drive this economy off a cliff. Thank you, Mr. Chairman.
Thank you, Senator Warren. On behalf of Chairman Brown, Senator Tillis, please.
Senator Reid, I'm going to defer and allow Senator Shelby to go before me, and then I'll follow in turn.
Quite all right, sir.
Thank you. Thank you, Mr. Chairman. Chairman Powell, earlier this month, Secretary Yellen acknowledged she was wrong about the risk of inflation. Previously, you also acknowledged that the Fed got it wrong in thinking that inflation would be transitory. Yet myself and other members of this banking committee here have been warning about inflation for over a year. Last July, nearly 1 year ago, when you came before this committee, I raised my concerns about the risk of, I mentioned the increase in energy prices, used cars and airline tickets. As someone who remembers, and I do from this committee, encountering high inflation during the 70s, I warned that many of the same conditions present then, such as loose monetary policy and significant government spending, were occurring again, among other things. My main concern last year was that the Federal Reserve would fail to address rising inflation before it was too late. 11 months later, this concern has come to fruition. And as we sit here today, inflation, as you've already pointed out, is at a 40-year high. The average gas price is over $5 a gallon. And we're currently in the midst of 12 consecutive months of inflation above 5%, including spiking to 8.6 last month. Ultimately, Mr. Chairman, as inflation continues to run rampant, I believe the Federal Reserve and this administration failed the American people by not heeding these warnings a year ago and by not acting sooner to address it. We're where we are today, I know that. The consequences of being wrong on inflation are now being felt, as has been pointed out here today, by American families and workers across the country. And despite the recent decision to raise interest rates, the Federal Reserve still has a long way to go to get inflation under control. What can we expect in the future from the Federal Reserve? And I know you don't have total control over inflation, but you have a lot of sticks there. And what will you use to bring this under control?
Thank you, Senator. So financial conditions, of course, have tightened and have priced in a string of additional rate increases, and that's appropriate. Well, as you pointed out, and as Senator Tillis pointed out as well, our policy rate is only at 1.6%, but all out the curve, the market is pricing in increases. So financial conditions have already priced in additional rate increases. But we need to go ahead and have them. And I think that the most recent inflation indicators of various kinds suggest to us that we needed to accelerate the pace at which we get up to a level that is neutral, that is close to the longer run neutral level, and then we can make an assessment of how much further and faster to go. And so that's what we're doing. I think you can see from the moves we're making now that we do understand the full scope of the problem, and we're using our tools to address it pretty vigorously now.
Mr. Chairman, explain to us again how important one of your mandates is price stability, how important price stability is to all Americans.
So price stability is really the bedrock of the economy in the sense that you really cannot have a sustained period of maximum employment, our other co-equal goal. You can't have that without price stability. And so we must restore price stability, and we will. We have the tools and the resolve and hopefully the judgment to accomplish that task. It's essential that we do.
What's your next step?
Well, if you look at the market has been I think reading our reaction function reasonably well, and I think what you will see is continued progress toward expeditious progress toward higher rates. I'll say this: the center of the committee wrote down that rates would be between 3 and 3.5% by the end of this year, as of a few weeks ago. As 1 week ago.
Is this Federal Reserve Board of Governors, under your leadership, committed, as Dr. Volcker was some 40 years ago, to bringing inflation under control no matter what?
I would never want to try to compare myself to Paul Volcker in any way, but I will say that we are strongly committed to restoring price stability. We do understand that it is the thing that we need so that we can get back to the kind of labor market that we all want.
But reaching the standard that Volcker left at the Fed would be a high reach, but one that anybody there should try to get there, wouldn't it?
Yes.
Thank you, Mr. Chairman.
Thank you, Senator Shelby. I'll exercise my time now. Mr. Chairman, you point out in your testimony that the core personal consumption expenditures minus gas, food, and rent, 4.9%, and even slightly declined from the previous report. So that leaves the real culprits, gas, food, and rent. First, the issue of gas price inflation is a global phenomenon. Is that correct?
Yes, gas prices are a function of oil prices to a significant extent, and then the refining spread as well.
Right. And that's has been exacerbated by the Ukraine invasion. We've deliberately, and the Europeans have deliberately cut off accessing Russian supplies, and that's added to inflation. And the other problem also with hydrocarbons, it's a cartel that sets the price. Is that accurate?
Sorry, what's a cartel?
It's a cartel that sets the price
Yes.
of oil worldwide.
Yes, globally, that cartel has a very major impact on the price of oil.
And they have decided that further production is not as lucrative to them as just sitting back and making money. That's what it appears like. With respect to food, there are multiple factors there also. One is climate. We've seen loss of arable land. We've seen a lot of factors. All of this is outside the purview of the Federal Reserve, but I think it's helpful to understand what are driving forces in these price increases. Transportation issues with respect to food, that's a function of higher diesel costs, a function of lack of drivers. Again, the Ukraine, a significant amount of wheat is not being exported from Ukraine or from Russia, as well as fertilizers. That's driving the price. And then the rental, affordable housing issue, that has been a crisis since I became a congressman in 1990. I recall marching in Washington for affordable housing in 1990. We just don't have enough. And that, I think, is a factor too. Are those the major causes for these increases in prices?
Those are some of the major ones. You could also point to some parts of the goods economy, which have been restrained capacity. And now you're actually seeing significant price increases in some of the service economy as it really reopens fully now. Mm-hmm. And that would be the travel and leisure sector.
There's another issue too. We talked about the cartels that dominate hydrocarbons, but we found, for example, during the pandemic, that there are really just 4 major meat processors in the United States. And with 4, rather than a multiple of that, there is the ability to indirectly restrain supply and increase prices. In fact, some of my colleagues, particularly in the House, have been talking about the antitrust aspects of some of these price increases. Is that a plausible ingredient to the problem too?
So I think that's really a matter for the competition authorities, not for us. But sure, I think broadly speaking, our economy is very competitive. There will be some industries where that's less so the case.
So these range of you have to take action, and your basically tool is interest rates and going in and out of buying public securities. But we have a lot of work to do too, which is to try to resolve some of these issues. And we have to do it in order to assist your efforts, the fiscal policy and other policy. I was very pleased to see the president sign legislation with respect to shipping reform. That's a step, but we have to do much more too. Is that accurate?
I think that's really a question for you. We're very focused on sticking to our knitting and carrying out the task that we've been assigned.
No, I appreciate that. And the independence of the Fed is something that has to be protected by everyone, including particularly yourself. A final sort of issue that I'm thinking of, we're at a tremendous, I think, turning point in our economy. Factors that 10, 15 years ago were not active, things like social media, et cetera. But one other factor with respect to hydrocarbons is perhaps the companies are either unconsciously or consciously limiting investment because they're anticipating an electrified power supply, electric cars, electric everything. Is that something that the Fed is looking at?
I think that is certainly, if you pick up the annual report of any of the big oil companies, you'll see that that is something that is happening, and it's a rational economic response to, expectations about where future policy is headed.
No, I think there are so many factors here, but I think it's good to get some of them on the table. And thank you very much, Mr. Chairman. With that, let me recognize Senator Tillis.
Thank you, Senator Reid. Again, Chair Powell, thank you for being here. By the Fed's own analysis of various policy rules, including the Taylor Rule, the revised Taylor Rule, the Balanced Approach Rule, and the Balanced Approach Shortfall Rule, rates should have begun to rise long before they did. According to the Fed's own analysis of these rules, the Fed's fund rate should currently be above 6%. This is in a report to Congress. Yet the rate currently stands at 1.6%. Likewise, these same rules should have prompted the Fed to begin raising rates Q4 last year, Q1 this year. I'm concerned that the Fed has opted out of rules-based to discretionary monetary policy. As the Fed reviews monetary policy strategy, Chair Powell, will you commit to considering an increased weight for a rules-based strategy in Fed decision-making, and if not, why?
So we do use policy rules like the various forms of the Taylor Rule in all of the analysis that we do. If you're thinking about how monetary policy will affect the economy, you have to have some sort of a rule like that. The Fed has never really used them in a prominent way to actually set policy in real time. But that's not to say they don't shed light, and we do consult them. We consult them on an ongoing basis. The rules called for deeply, deeply negative rates during the pandemic, and we didn't do that. They did call, of course, for rates to move up, and rates now really are moving up much closer to where the Taylor Rule, various forms of the Taylor Rule are, and I think by the end of the year we'll be pretty close to where some of the Taylor Rule iterations are. So it's something that we consider. I think in a couple of years when we look at our framework again, that's something we could look at.
And Chair Powell, could you just briefly explain the variance between rules-based decision-making being at 6 and where we are today? What other factors came into play?
So what Taylor rules don't take into consideration changes in financial conditions. They just look at the overnight policy rate. As I mentioned earlier, we began signaling, and the way we're set up now to signal policy changes going forward with the summary of economic projections that we do 4 times a year. So markets priced that in, and you're getting a lot of policy tightening well in advance of actually raising rates. As you pointed out, we're at 1.6% only on the federal funds rate, but look out the rate curve. All the very substantial additional rate hikes are already priced in, and they're affecting financial conditions, and they have been for several months. So that's one way of thinking about it. It's really only at the very short end of the curve where rates are still in negative territory from a real perspective. If you look farther out, real rates are positive right across the curve, and that's really what you're trying to achieve with policy in a situation like this where we have 40-year highs in inflation, and we know we need to have restrictive policy, and that's where we're headed.
Thank you. In 2012, the Fed adopted its current 2% inflation target, then amended this in 2020 to allow inflation to run over 2% target so that inflation averages 2% over time. Many warned this approach would simply give inflation a foothold before the Fed could respond. Now inflation's at 6.5% per year, and many serious analysts are predicting a recession. According to the Fed's framework, will the Fed push inflation below 2% so that it averages 2% over time?
No, that wasn't the way the framework worked. And I should clarify, though, the framework was carefully focused on what we knew, which was the economy of the last 25 years. The pandemic hit a few months afterward, and I think we've been aware since reasonably quickly after that the disinflationary forces of the last quarter century have been replaced, at least temporarily, by a whole different set of forces. And those are the forces that our policy is has been reacting and dealing with, and we're well aware of that. I think that what we were looking at was a world in which you didn't see inflation move up even when unemployment was for an extended period well below 4%. This is a different economy, different forces. The real question is, how long will this new set of forces be sustained? And we can't know that. But in the meantime, our job is to find price stability and maximum employment in this new economy.
And final question is, there is some renewed discussions about increased spending and increased taxes through reconciliation. Just hypothetically, if Congress were to pass a bill that increased spending by $500 billion or $1 trillion and raise taxes, would that make your job easier or more difficult?
I swore off getting involved in these fiscal debates a year or so ago, and I'm determined to see if I can't stick to that. But remember, we can always incorporate. What we do is we take fiscal policy as given and we react appropriately.
Well, then maybe instead of policy working through Congress, but policy that was passed by Congress, do you believe that the $1.9 trillion spending package last year had any effect on inflation?
This is really not our job to pass judgment. We didn't pass judgment on the Tax Cuts and Jobs Act or the CARES Act or that act as well, the ARP. So I really think that's a job for Congressional Budget Office.
Thank you, Chairman Powell.
Thank you, Senator.
Senator Cortez Masto of Nevada is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Let me start with high prices. Because not only in Nevada, but across the country, we're seeing high food, housing, and gas prices, which really is creating a financial hardship for too many families. And I want to start with gas prices first. In Nevada, average price of gas is $5.60. In Las Vegas, about $5.60. In Reno, at $6 a gallon. And as gas prices rise across the country, oil and gas companies, we know, are making record profits, but are using that money to continue to consolidate their industry and pay for stock buybacks instead of investing in increased oil production. On one of them, and one I've heard, is over 9,000 permits that they have that are unused drilling permits, or they're not expanding their refining capacity. We also know that reduced refining capacity is a particular problem that has been caused in large part by decades of oil industry consolidation and is driving gas price hikes to be as much as 61 cents a gallon higher than expected. So when considering the drivers of inflation, how much do Federal Reserve economists consider consolidation in an industry? And what else can we do to hold these industries accountable for their contributions to rising prices?
Those are really questions for the competition authorities, questions of industry structure and consolidation. They really aren't questions that we directly address. We raise interest rates, and our job is maximum employment.
But I have to push back. You have to consider that. I mean, you're considering what's happening in Ukraine as a variable on inflation and high prices. So you have to consider the fact that we have these oil companies. They are exclusively control this commodity that is key for this country. We know that not only do they produce and decide how and when they're going to drill crude oil, we also know the refineries, and quite honestly, the refineries in this country are not prepared to refine the domestic oil that even comes from Texas and the Dakotas. The refineries are prepared to refine the oil that comes from out of this country. And we also know that many of the oil companies have their own traders that are trading on the price of crude oil in this country. I mean, listen, you just talked about an outside agency. This is why this is so important and why I am a co-sponsor of the Transportation Fuel Market Transparency Act. Glencore was just fined $1.1 billion because they were manipulating the fuel oil prices to their benefit. So that is something you have to take into consideration when we have an industry like these gas and oil companies that are so consolidated. They are having an impact on the prices to the detriment of the people in my state. So that has to be something you consider and take into consideration when you're looking at the impact that people across the country are seeing from these high prices. I hope it is. Please tell me you are.
Well, I think we see that the global oil prices, which have very important effects on gas prices here at home are set on the global market, and that, as we mentioned earlier, there's a large cartel that is responsible to a significant extent for setting those prices. We take that as given.
So do you pay attention to what is Wall Street is saying and what these cartels are doing? When you say cartels, these are these big oil companies, and they're indicating that, well, I'm not going to drill because I'm making profits because the price of gas is so high. So you would assume, I would hope that you would take that into consideration, that it's going to continue these high prices because there is a challenge in holding these oil companies accountable.
So in principle, we pay attention to anything that could affect the use of our tools and the need to use our tools. And I think with the future price of oil, the best thing you can probably do is look at oil futures, because that futures in theory should be taking into account all of these factors, and that's what we do. But ultimately, the question for us is, do we raise or lower interest rates? We don't have tools that would address these practices that you're discussing. They're not really, of course, we understand them.
Well, do you have concerns that these oil companies are manipulating or controlling the prices that we have right now? Do you take that into consideration with the tools that you need to reduce inflation and reduce these costs?
Honestly, those are not judgments for us to make. The questions about industry structure and competition are really not, it's not our assignment. Our assignment is employment and price stability.
The outcome of that infrastructure is something you've got to take into consideration.
Yes, very much.
Unless they change, the prices are not coming down. Unless they stop giving profits and sharing that with their shareholders and start addressing and looking at actually the consumer at the other end of this, who is bearing the brunt of it, these prices are not going to come down. I would assume you take that into consideration. Maybe I'm wrong.
Well, when you say take it into consideration, we do have to have a forecast of oil prices, and we do. But ultimately, though, the question for us is price inflation. What's happening with price inflation? And it's a macroeconomic question. It's not a question about industry structure or corporate behavior. It's a question about what will be the behavior of inflation across the economy. And in particular, there's really not anything that we can do about oil prices. There's a little, food prices is a bit more mixed, but for oil prices, they're set at the global level. It has to do with global oil prices and also the refining spread. Neither of these are things that we have the tools to affect.
Does it concern you that these oil companies haven't come to the table to look for a solution to help us reduce fuel costs?
I don't think it's appropriate for the Fed or for me to be reaching out into areas of policy that are not assigned to us. It's not up to us to comment on that sort of thing. We have a very specific job and precious independence to carry that job out. And I think the other side of that is stick to that job. And our job is maximum employment and price stability.
Thank you, Mr. Chair. My time is up.
Thanks, Senator Cortez Masto. Senator Rounds from South Dakota is recognized.
Thank you, Mr. Chairman. Chairman Powell, welcome again. It seems as though for the last couple of times that we've had you in front of this committee, inflation has been a primary item of discussion. I want to follow up just as my colleagues have, and I'd like to take it in a little bit different path, perhaps, because when it comes to breaking down the different causes of inflation, clearly there is the supply side and the demand side. And the reality is that a large portion of the inflation stems from the higher energy prices, which is part of the supply side issue. When President Biden took office, January of 2021 through January of 2022, the price of unleaded gas has increased by 50% during that time period, from $2.33 to about $3.30 per gallon. Now, that was well before the Russian invasion of Ukraine. Higher prices are instead, I believe, a direct result of policy decisions made by the Biden administration, like prohibiting new oil and gas leases on public lands and waters and choking off future access through the Keystone XL pipeline, and increasing U.S. dependence on foreign energy sources by actively calling on OPEC to produce more oil. All of these seem to send a terrible message to the market about the future of investing in oil and gas processes within the United States. At the same time, Mr. Chairman, your tools are designed, as we've discussed in the past, to impact not necessarily the supply side, but the demand side of inflation. So if you attempt to use your tools that are available at this time to address what I believe to be the policy-induced side of inflation, do you risk hurting the economy by using these interest rate increases when, in effect, as you've indicated earlier here in this meeting, that you really can't impact the price of gas or the price of food?
I think that's right. We know that our tools can't affect certain aspects of inflation, and that would include certainly energy inflation and food inflation. So nonetheless, our statutory goal is headline inflation. But we also know that core inflation is actually a better indicator of headline inflation than headline inflation itself is, because food and energy tend to be quite volatile. They tend to move up and move down, and that's been the history. So core enables us to look through that volatility. And so we focus very much on that as a better representation of what underlying inflation of the economy is at any given time.
And I think but in this particular case, that core inflation, if we're not going to include some of those, what I think earlier we thought would be transitory in nature portions of inflation, they have proven not to be transitory. In fact, South Dakotans are now paying $682 more per month on goods and services than they were when President Biden took office due to inflation. The administration is claiming the Federal Reserve can fix our inflation problem. But as you've just indicated, you focus on core, and your tools might very well work on core, but not on those really heavy drivers to inflation that South Dakotans are seeing like the rest of the country. See, Mr. Chairman, what I believe is going to happen here, and I just share this, clearly you are aware that you're going to be the person that takes the fall if inflation is not brought under control. And this administration is going to point to you and to the Federal Reserve saying, you have the tools to fix inflation and you're not doing your job. When in essence, the portion of inflation which Americans are feeling today may not just be the core inflation that some of your tools do, but the total cost of inflation that my citizens in South Dakota feel to the tune of, well, $682 more per month in living expenses than what they were when this administration took office.
So we're focused on the part of it that we can address, and that is there's a job to do on demand here. There are parts of the economy where demand exceeds supply, and that's where we think our tools can help, and that's what we're focused on.
Very good. Just very briefly, Mr. Chairman, another item. The Basel Committee on Banking Supervision issued a press release indicating that it had made substantive technical changes to the calculation of the GSIB score for EU-based global systemically important banks, the GSIBs. Do you, the Federal Reserve as being a part of this organization, do you believe right now that this change reflects the views of the Federal Reserve as an influential member of the Basel Committee? Apparently, it looks like this may very well provide some advantages to our European banks over U.S. banks based upon this reassessment of how they view risk within the EU community.
So my understanding of that is that it's really about supervisors being able to use discretion about transactions that go across national lines within the European Union.
Yeah.
It doesn't apply at all here. And ultimately, the capital rules that Europeans apply are decided by Europeans, not by us.
Very good. Thank you, Mr. Chairman.
Thanks, Senator Rounds. Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman, and Chairman Powell. It's good to see you again. Thank you for your service to our country. I want to go a couple of different directions. First, and I think some colleagues have already raised this. Well, the truth is, what we're grappling with right now on inflation is clearly a global phenomenon. I think even the Cato Institute group that doesn't always necessarily agree with folks on my sides of the aisle have pointed out inflation in many industrial countries around the world is running at the same rates, if not higher. I frankly just returned from a bipartisan trip.
All right, everyone. So I'm actually going to be sharing this link with everybody to continue watching the hearing here. I've got a lot of notes, and for the most part, I think a lot of it, one of the big questions that I think what he said about not having any control over gas and food prices, That was big. I think that's really important for him to admit that, because we've been talking about it for a long time. I posted a video just, I think maybe last month, or going over when the last CPI numbers came out, going over how the Fed has no control over the narrative, which is the price of food and energy, which is a big component of overall inflation. And to that, he obviously pivoted and said that we're focused more on core CPI, bringing that back down, and of course affecting the demand with interest rate hikes here. But obviously that poses a big risk. If you keep raising rates as aggressively as he is going to, which he will, then unfortunately we're going to be in a situation where unemployment starts to go higher, and there is going to be a possibility of a potential recession, because, like I said, it's more a political issue. As much as we hate to talk about politics and all that stuff, unfortunately, the parties that are in control of overall energy prices are, we've got the POTUS, we've got OPEC countries, we've got oil companies. So those are the parties that are, it's more of a political issue when it comes to energy prices and food overall, and not just, just the commodity prices, which is what the Federal Reserve controls right now. So, so it doesn't have any control over, gas and food prices, because those are things that, people already need. So they're not going to spend less money on that, because those are necessities for the Fed. But anyway, so what we're going to do is we are going to cut it here. The market's obviously very, very green right now so far, pushing higher, very much positive. A lot of stocks are pushing up here intraday. That's something that we also talked about pre-market when the polls were very much in the red. I was a little bit skeptical, because this week, like I said, I'm a little bit more optimistic. Just this week, though, we'll talk about next week when next week is coming up. But this week, I'm a little bit more optimistic about a technical bounce here, just given how oversold conditions were. But don't forget, don't mistake this with a sustained recovery, because a lot of things are still pretty elevated. Inflation is high, interest rates are going higher. So those are some things to consider as well. So again, thank you so much for joining. I really appreciate it. I'll send the link to our Discord members to watch and of course continue with this Senate meeting. It's going to be a 2-day event. We're going to be live once again tomorrow. So listen in. So hope you all enjoyed. Make sure that you drop a like and subscribe if you're new to the channel. And also check out the links down in the description to join our Discord and our private money investing community. I'll jump over to our Discord and send some updates over there as well. So happy investing, and I'll see you guys first thing tomorrow morning for another